welcome to the first episode of Money Talks for 2026. I hope subscribing to this podcast is going to be among your first New Year's resolution. If you're listening to this, then hit the subscribe button, okay? I'm Andrea Heng and I am ready to start this year right. And one of the ways that we can do that is to perhaps take stock of, well, your stocks. Personal finance isn't just about that. It's just not a singular thing because we have to think about the global uncertainty. We have to think about things like supply chains, conflicts around the world, interest rate decisions made by various central banks, not just here, but around the world as well. It's hard to plan your household budget when you don't know where the global economy is headed for. Today, though, we're going to get some kind of help with an economic roadmap of sorts for the year ahead to help you figure out where you stand. So joining me in the hot seat today on Money Talks is Selena Ling, the chief economist for OCBC. Welcome, Selena.
Thank you, Andrea.
Let's start with a gut check, so to speak. As we head into 2026, are we looking at a global recovery or a slowdown?
Well, it's a very interesting question because having gone through the roller coaster ride in 2025, my best guess is that if we have stable but still uneven growth in 2026, that's probably the best case scenario. We just don't want any more nasty surprises on the side of US tariffs or more, geopolitical conflicts or hotspots, things that could basically throw financial markets off track again.
Yeah, I believe it when you say, that roller coaster ride. It really was a very bumpy ride in 2025. Now, looking at the US and Europe for a start, the narrative seems to have shifted back and forth quite a bit over the past year. What are some markets to watch out for this year?
Well, that's a very good question because you remember the US economy essentially was the star for, the previous few years, right? They have outperformed market expectations. All those speculation about US recession didn't materialize. And that's despite the onslaught of US tariffs. So actually very, very resilient. So I'm keeping my fingers crossed. We will have a slowdown in 2026 for the US economy. We are starting to see, of course, some tentative signs emerging in the labor market that, job hiring is slowing and the unemployment rate is creeping higher, now above a 4-year high. But nevertheless, I think essentially it's not too bad a story given, all the antics that we've seen on the tariff front. For Europe, it's a very different story. They went through a period of very sluggish growth. Now there seems to be some signs, that things are picking up. A lot of them, of course, is predicated on the hopes that, Germany, for instance, and the rest of Europe is going to accelerate their defense spending, partly due to US actions as well. And that is going to drive a key part of the industrial sector. So the European Central Bank, for instance, seems to have approached a pause, if not the bottom of their interest rate cut cycle. And that's very different from the US Federal Reserve because they have started to cut rates in the second half of 2025 and they are signaling, probably more cuts to come. And markets very hopeful that there will be a lot more US rate cuts to come.
Yeah, I get that sense as well. But how do we make sense of there's almost a divergence between what's happening in the US and what's happening in Europe. And we haven't even brought Asia into the picture yet, right? So how do we make sense of such multipolar paths in a way when it comes to all these different economies in the world?
I think financial market attention tends to be very fickle. Of course, when they think that the US economy is losing some steam, they will look for alternatives and hence they, reshift the focus to Europe and it goes back and forth.
Right. So you're expecting investors to sort of be bouncing back and forth a little bit, being a bit more nimble in that sense?
So the irony is, the US has always enjoyed a very privileged position, right? When the whole global economy was in upswing, US outperformed. A lot of investors focused on the US markets and, we did see the US equity markets had a phenomenal run, especially for the Mag 7 stocks.
Oh, yeah.
Because people were buying into the whole AI hype. And, Europe kind of took a back seat. But, on the contrary, when it's risk off, when people feel very uncertain about things, that's also when, the safe haven status of the US dollar comes into play.
Yeah.
So a lot of short-term versus long-term kind of factors, a lot of positioning, overweight which region, which markets, and even in terms of asset classes, right? Equities being more risk on, bonds typically being a little bit more risk off kind of bias.
You talked about AI earlier, and I wanted to pick up on that, Selena. There's been a lot of talk about this elusive AI bubble. When is it going to burst? Will it not burst at all? Where do you stand on how this, figurative AI bubble looks like? What does that look like to you right now? Or is there even one in your mind?
Okay, that's a very interesting question. Everyone is interested in the AI story. I think we have to, draw out some of the nuances of this.
Yes.
Right? In the short term, because of the huge ramp up in terms of the AI stocks, okay, there is, of course, clear risk of a correction because people are worried about valuations and whether they can actually deliver the earnings in short order.
Yes.
So I'm a firm believer in the medium-term productivity gains of the AI adding value to the real economy. We have already seen it in our day-to-day lives. We use AI everything from ChatGPT in our work to planning our travel itinerary and, of course, a lot of the other work, mundane stuff that we hope AI can actually replace. But for firms, the huge hopes that they think AI can replace a lot of workers in short order, that may not materialize.
Okay.
And besides, because we see that AI investments are huge, the magnitude of money that is being poured into this sector. So, like I said earlier, financial investors tend to be fickle. If they don't see quick returns,
Precisely.
you will see, bumps along the way.
So it looks like it's going to be yet another bumpy ride for the AI sector after quite an uphill climb in growth, at least. We are talking about non-stop about valuations and how skyrocketing they are.
I think one of the issue regarding the AI bubble, also as you title it, really is because everyone's overweighting the US equity market, and everyone's overweighting that few US AI related stocks, right? And then when they see that, the AI companies are investing in each other, then they will get a little bit concerned. But I think if you look broader outside of the US equity market, and we have to remember, like what happened back in the tech bubble burst previously.
Yes.
Okay? The winners of today may not necessarily be the winners of the future.
Yeah.
So it's something to take note of.
Yeah. Do you feel like a lot of it is also driven by FOMO?
Oh, definitely.
Yeah.
FOMO has always been the name of the game when it comes to any bubble. I mean, it could be any asset, right? It could be commodities, it could be equities, it could be private credit, it could be China stocks, it could be anything.
But you don't really see that kind of FOMO behavior when it comes to the boring stocks, right? Your utilities, your consumer staples, for example. Why is that? Is it because tech is supposed to be this exciting new thing that people want to get an head start on?
Well, I think, of course, novelty value is one.
Okay.
But also because we do see probably some of these technological disruptions being a very kind of long-term scaling path into productivity growth and also real GDP growth at some point. It's just a question of current expectations versus, more medium-term returns.
Indeed. Okay, I want to turn to another market now outside of the US, and that's an economy that everyone is also watching very closely. It's the Chinese economy. How much of a factor will the Chinese economy be in 2026? Because depending on who you talk to, and I've spoken to quite a number of people, including yourself in the past, depending on who you talk to, there is one narrative that says, okay, China will grow, but moderately. There are others who will say, no, the growth will stagnate. It won't be any more than what it is now. There are others who say it might even weaken because of the tariffs situation from the US, among other things. So what's your take? How do you assess the Chinese economy and its impact on the global market system?
Well, China is very important. It's like a giant elephant.
Yeah.
So depending on which part of the elephant you're touching,
Right.
you will have a very different narrative to tell. I think on one hand, if you look at the GDP growth performance in 2025, I mean, it did basically exceed market expectations despite the tariffs.
That's right.
So a lot of it, of course, has to do with the policy support that is coming through. But I also think that they have a lot of underlying structural issues. The whole lie flat or tang ping phenomenon that's affecting confidence levels. And of course, you have the property sector that remains very, very troubled.
That's right.
So oversupply, overcapacity, now they have this involution that's going on, and the government has come out with anti-involution measures. I think what's quite clear from the policy agenda is that there are no quick fixes. So we don't expect that there will be a policy bazooka like what we saw back in 2015.
Yes.
China's growth at best will stabilize, but we're not really expecting a reacceleration.
Okay.
Will it soften further in time to come? I think that's very likely because it's the process that Japan and all the advanced economies and even, Singapore, South Korea and Taiwan have gone through.
Yeah.
Right? Because it's population dynamics working against you.
That's right.
Right? Population is aging, you're benefiting less from the population dividend. And as time, as you move up the cost structure, your competitive advantage also changes.
Yeah. Could you illustrate for us here, real quick, how population dynamics has an impact on, the kind of economic measures and policies that governments think about?
Well, I think if you just take the example of Singapore, for
Sure.
instance, right, our total fertility rate has dropped, to below 1. So we are not replacing ourselves. We have to supplement with foreign workers and foreign talent, but there could be a capacity limit to how much you can absorb due to infrastructure and other constraints, right? So for China's case, they are a very, very big economy with a huge population. In the past, they were adding a lot of young workers. But of course, the one-child policy has also meant that, their population growth rates are also slowing down.
Yes.
And I think more importantly in this current juncture, because of the global economic circumstances, they are struggling to, create jobs for the fresh graduates, for instance.
Yeah.
So they stopped publishing, the youth unemployment rate some time back because it was climbing to quite high levels. So I think there's a bit of that social aspect to, growth and also population growth that will basically drive what are the medium-term potential growth rate that China can have. So, in the past, in the 90s, we talk about the flying geese kind of phenomenon where Japan leads, and then with, Singapore, Korea, and also Taiwan benefiting from the manufacturing boom.
Yeah.
But we also see that in China now, they used to be the factory of the world, and the cost structure has changed.
Yeah.
And some of the other upcoming countries, whether it's India or Vietnam, basically are seeing cost advantages to manufacturing and production.
Yeah, because you're seeing China starting to pivot away from wanting to be the global manufacturer because they want to push that made in China brand a bit more to the front.
I think that doesn't mean that China will not continue to be at the forefront of manufacturing.
Okay.
They will be, because if you look at the advances they have made on the manufacturing front, whether it's AI related or whether it's the green economy or whether, it's in semiconductors, EVs, for instance, solar
EVs.
panels, there's so many things that they actually excel in. But they may actually produce the technology. They may not be the one manufacturing it. I think that's the model that a lot of countries have gone through.
Right. That's an interesting take. Thanks very much for that explanation, Selena. Okay, so obviously you've painted quite clearly the kind of global headwinds and tailwinds that we need to look out for. So what then is your GDP outlook for us here in Singapore for 2026?
Well, I'm looking at basically kind of medium-term trend growth. We're probably looking at 1% to 3%.
Okay.
And we have to take this in the context that actually 2025 was excellent.
I know. Everyone was afraid that number will come down, and we ended up being quite a lot more resilient than we thought we would be.
Yes, and I think if you look at the 2 upgrades to the official growth forecast that
Yes.
tells you how the fortunes actually turned out to be better than expected.
Yes.
And I think there are 2 things to thank for that. One, of course, was the whole AI boom. So Singapore, as a semicon manufacturing part of the value chain, did benefit from a lot of that.
Yeah.
And I think secondly, I think there is also the whole front loading that was happening.
Yes.
ASEAN was seen as a neutral production base. So a lot of the China plus one, China plus N story was coming to ASEAN. And I think we continue to see that strength in terms of foreign direct investments coming in. But interestingly, I think even China themselves, the outbound investments, going out from China into the rest of the world, particularly to ASEAN, is also growing.
Yeah. While we are on the subject of forecasts, Selena, here's another one for you. What's going to be your prediction for the interest rate environment this year? Especially knowing that in the US, Jerome Powell is no longer going to be Fed chair for much longer.
So I'm looking for the Singapore economy to grow between 1% to 3%, hopefully in the higher end of the range between 2% to 3%. But it really depends on the global economic circumstances.
Sure.
And in terms of interest rates, they will very much take the cue from the growth environment and also what the rest of the major central banks are doing. So you mentioned Jerome Powell. It's quite clear that President Trump already has someone in mind. He's supposed to announce it fairly soon. The candidate, whoever it is likely to have a more dovish slant compared to the current chair. And that's why markets are very optimistic that there will be more than one interest rate come in 2026 itself, even though that's the median dot plot that the Fed members have actually articulated earlier. So there is quite a few changes that's going to happen on the Fed Board of Governors, not just the chair itself, but we have also seen Miran being, appointed.
Yes.
And then there's the ongoing, case with Lisa Cook.
Yes.
And a few other of the more dovish members. So I think it's very likely that we'll have a majority of more dovish composition in the Fed for 2026 itself. Of course, whether that translates into actual rate cuts, that's another story, because it will be very much dependent on the inflation and also the job market outcomes, which are the twin mandates for the Fed. So our baseline case is, yes, one more cut in probably the first half of next year, but the ongoing story from that really would be very much data dependent.
Okay.
So Singapore doesn't have an interest rate policy. We have an exchange rate policy. So we also did see the MAS basically ease monetary policy in January and April of last year, and they have basically paused for July and October.
Yes.
So, coming into Jan itself is the next quarterly meeting. Our best guess is that they will stay pat for now, mainly because I think inflation has clearly bottomed in the second half of 2025. And while core inflation may edge up a little bit, but it should still be within their comfort range of 0.5 to 1.5%. So no urgency to cut further, but no urgency to hike either.
Yeah. Okay, interesting. And yes, if you want to know how the MAS, our central bank, works out monetary policy, you can check out our Money Talks episode on how that works, the policy band, the SNEER, they call it. So while we're still on the topic of interest rates, what does this mean then for homeowners? Everyone's concerned when it comes to interest rates because of their mortgages, their car loans even, or any kind of loan that's going to affect interest rates, right? So what does this mean for regular folks like you and I?
So what happens when MAS, maintains or changes its monetary policy stance with the SNEER, as you referred to it? Okay, that has an impact on interest rates because it may either attract or, be less attractive to foreign portfolio flows coming into Singapore.
Yeah.
Right? If more flows are coming into Singapore because in anticipation of appreciation of the Sing dollar on a trade-weighted basis, that actually depresses domestic interest rates.
Yep.
So that's how it's connected.
Okay.
But I think as far as interest rates are concerned, we did see that they came off quite sharply in 2025 itself, and it appears to be reaching some base levels in the second half of 2025. So I think going out, if we expect that MAS continues to stay on hold on the exchange rate front,
Okay.
and also that, core inflation starts to edge up a little bit gradually, then it's likely that you will not see any more dramatic falls or declines in the domestic interest rates.
Okay.
So we'll probably, probably have seen the bottom, I think, barring any unexpected crisis again.
Okay.
So I think as far as existing homeowners or people looking to refinance your home loans,
Yeah.
probably this would be already a sweet spot to try and lock in some of the domestic mortgage rates. I don't think that they should expect that there will be another huge decline in the mortgage rates from here.
Okay.
But of course, we know that, whether it comes to property purchases or car purchases, interest rates are just part of the story.
Oh, yes.
Because it's also to do with pricing of the big ticket items,
Supply
right?
versus
Yeah,
demand.
supply versus demand for property. There's always that constant fear of cooling measures.
Yeah.
And then for cars, of course, is the COE premiums as well.
That's right. And the number of COEs, how much have been subsumed, how much is going to be released. It's a multi-factor situation. Yes. Thanks for the reminder. Now, I wanted to go back to what you talked about in your last couple of answers, and that was core inflation, right? And you do expect it to edge up slightly over the course of 2026. So and I think this has been a point of conversation in the past as well about how, yes, inflation has bottomed out somewhat, and even if it does edge up, it's not going to be that bad, but I'm still feeling that pocket is not very deep.
Okay, I think we have to remember that inflation is basically the growth of rate of prices, right? So if inflation goes up by 1%, it means prices go up by 1%, right? If it slows down to 0.5%, for instance, it just means prices are still going up, except at a slower pace, right? So, exactly what you mean by, people feel that the cost of living is still high because prices are elevated compared to the past. So we had a, period during the pandemic when there was very little demand. Hence, we saw that, prices, particularly global commodity prices, plummeted.
Yes.
Right. And since then, prices have been on the uptick. Right. Some of it, of course, exacerbated by supply chain disruptions.
That's right.
But a lot of it, of course, is also because of demand coming back. Right. So going out from here, even if, the MAS forecast core inflation will grow by 0.5 to 1.5%, it means that your plate of chicken rice or char kway teow is still going to go up.
Yeah.
It's just going up at a slower pace. So I think really barring, a global recession or financial crisis or global pandemic of the likes that we saw back in, 2019, 2020, prices will stay elevated. They just may grow at a slower pace of life.
Right.
I think what is really key is what is the employment story.
Yes, I was about to get to that. Yeah.
So whether the employment rates also start to rise, whether your wage increase keeps pace with the inflation rate.
That's right.
Right?
Yeah.
If, let's say, your wage growth is growing at 2%, inflation is at 1%, you're still better off.
Yeah.
Right? But if let's say your wage growth is only 1%, core inflation is 1%, net you're no worse off, no better off.
Yeah. You didn't beat inflation.
You didn't beat inflation.
But you can still live.
Yeah. But of course, if you're unemployed, then it's a completely different story.
Yeah.
Then any growth in inflation is still going to hit you.
Yeah.
Right? And then, of course, for those who are in the position of having ample surplus cash, then is also how you make the best use of investing that
That's right.
surplus. Whether you are getting returns that will actually beat inflation. So if you are investing in whether it's stocks or bonds or any other products, for instance, and if that's fetching you a nominal return that's higher than inflation, then your real return is still positive.
Yeah, that's true. And that's a silver lining there to look out for. Just to cap things off here, a little advice time now, Selena. For those of us who might be feeling anxious about the headlines. And that's something that carried on all throughout 2025 and certainly going into 2026. It doesn't seem to be abating. What is one economic indicator that we can pay attention to this year?
Wow, one economic
It's
indicator.
hard to pick one when there's so much going on, right?
I watch a lot of economic indicators. You want me to just pick one?
Yeah. I mean, okay, for the average Singaporean, the auntie, uncle in the coffee shop, me explaining it to my mother, what's one thing that I need to watch to see and determine if I'm financially all right?
I think if you're talking basically about what to do with your money, then you will have to watch what's happening in financial markets,
Okay.
right? My advice is actually to cut through the noise because it gets really, really noisy.
It
Every day
does.
you're bombarded with information, interest rates coming down, interest rates going up, inflation coming down, inflation going up. It can get very, very confusing.
It is,
right?
yeah.
So my advice is don't get too FOMO.
Okay.
Don't hop on a bandwagon because of the fear of missing out. You really have to look at your own portfolio and look for diversification. Don't put all your eggs in one basket.
Yeah.
Right? And I would say the one indicator that is most important, it may not be an economic indicator, is
Okay.
your job. Right?
Right, yeah.
If you continue to add value and you have job security or job certainty, then everything else, all the other uncertainties can be managed.
Yeah.
Right? So actually, I would say that that's the most important indicator that we all need to focus on,
Yeah.
because that at the end of the day is what determines, whether you're beating inflation,
Yeah.
whether you have surplus cash to invest, etc., etc. And of course, to take holidays, which all Singaporeans love to do.
Especially when the Sing dollar is still pretty much very, very strong. Good to know what's coming down the pike, Selena. Thanks so much for laying all this out for us. And thank you for being my first guest of 2026.
My pleasure. Thank you, Andrea.
And thank you to you, our Money Talks community out there, for tuning in. Now, if you've got any comments or questions, you can always leave us a message. Write to us at cnapodcasts@mediacorp.com.sg. We do read our emails, don't worry. Money Talks is available on Apple Podcasts, Spotify, YouTube, and Me Listen. Rate us where you find us. Tell us that you like us, especially for 2026. I'm Andrea Heng, signing off for the Money Talks podcast. Here's to a fantastic 2026 ahead.